So what do names like Paris Hilton, Kylie Jenner, Kim Kardashian, and Hunter Biden have in common? What do you think? Well, they're all heirs to generational wealth. Millionaires and billionaire dynasties. How nice, right? But when you think of them, did you think of the words like responsibility, wisdom, intelligence, they're humble, and they're role models? Well, maybe you think, they could be a role model, but not very good ones, especially the latter one. So when it comes to creating wealth for your kids, how do you do it right? Like, what are you gonna do that makes you different than those names? And how do you pass on your wealth responsibly? I'll tell you the truth. It's with the infinite banking concept. You see, you can set your kids up for life, but I wanna warn you, it can come at a cost if you don't do it right. So that's why I've created this video. I want to teach you some of the right ways to help your children create massive wealth, but without, well, the problems that you were talking about with those other people. So let's just assume that you've created a policy for your child, and now you want to know how to pass it off the proper way. So in today's video, that's what I want to do. I want to show you what I'm doing for Vivi's policy. I want to show you how I'm building her up so that she will be ready for this policy to be passed on to her. But it won't just be one policy, it'll be a lot. But before I do that, let's get to the super fun stuff. This is the best part of the video, and it's called the subscribe part. Right now, click the subscribe button. And hey, while you're at it, why don't you hit that alerts button right? That'll leave a mark. That's right, the alerts button right up top. Yeah, smash that alerts button and then throw it back at the asshole that threw it at you the first time. So as you can see, if your kids are throwing things at you, they're probably not ready to manage their private banking system. Thanks for subscribing and clicking that alerts button. You didn't have to get hit by something thrown at you. You're pretty awesome though anyway. But let's move on. So what are the benefits of creating a policy for your kids? Let's talk about one of the things you could do. You could set up a policy and have your child be the owner of the policy. So let's first talk about ownership. And let's talk about having your child own the policy. So let's start with ownership in the child's name. So if you have a policy and your child is the owner of it, it will provide for a lot smoother transition. So should anything ever happen and you want to transition that financial responsibility over, that transition will be a lot smoother because the policy was already in their name. But by doing that, that policy is also controlled by them. And I want you to give some thought to that, because if you turn a policy over to your child around 18 years old, are they ready for that policy? So if you're going to set up a policy for your children, chances are if they're minors, they can't be the owner of the policy. You would have to be. So you as the parent would be the owner and usually the payor, unless your kid is a YouTube superstar and they're funding it, you're probably going to be funding the policy. Now, the policy can be transitioned to your child at around 18 years old. Now, there's different states that have different rules, but let's just call it 18, because a minor can't own the policy, but when they're 18, they can. But I want you to think about that. Should they own a policy at 18? Should they have full control over all the cash value? Are they responsible enough? These are some of the things that we're going to cover in this video. But first, before I get to that, I want to talk a little bit about the death benefit on a kid's policy. Now, I know when we build these policies, we build them for maximum cash value, but hear me out. When you set up a policy for your child, like I set Vivi, my daughter's policy, up when she was 6 months old, and I only put $5,000 a year into her policy. But you know how much of a death benefit that buys on a 6-month-old? Well over $1 million death benefit. Think about that. So a very low premium deposit gets a whole lot of death benefit coverage. And because these are specially designed whole life policies, not term, these policies never end. So that policy that I set up for my daughter at 6 months gets her over $1 million. You know how much it would cost me to get $1 million policy? I barely could buy a policy for $400,000 for the same premium deposit. Now, because she's so young, that buys over $1 million. If I'm not mistaken, I think it was about $1.8 million for $5,000 in premium deposits. So why wouldn't you want to set your kids up with a big death benefit while they're young when the death benefit costs peanuts? Well, the answer is you should. But I know you want to talk about cash value. That death benefit, my kid's going to live a long life. I know. But there's one certain in life, actually two, death and taxes. So someday we all get to go home and graduate, okay? When that happens, the death benefit piece, which a lot of people stress about later in life, because when do people want to buy a death benefit? When do people want to buy life insurance? 60, 70. Why? Because then they're starting to think about legacy. And what's the problem? It's so expensive, but not for a kid. But since we're designing these for infinite banking, the policy serves as a private bank for your child. And it allows them to borrow against the cash value, and that cash value can be used for significant life expenses. So because we're designing these for the infinite banking concept, the policy is really going to serve as a private banking system for your child. And it's going to allow them to borrow against the cash value in the policy. And that cash value can become significant, and it can help your child with significant expenses that they come up with. And buying the things that they want. Like Vivi, in her policy, she'll be able to fund her college, she'll be able to pay for her house, her cars, all the big expenses that most of us, when we were growing up, we didn't have a private banking system that was set up when we were little. No, we had to go out to the school of hard knocks, work on a farm, work in a restaurant, pay for the car or finance the car and make monthly payments. And we got caught up, and that caught up landed us in a lot of debt. And I know you don't want that for your kids. So you got to teach your kids how the infinite banking concept works. So if they set up their own private banking system, or I should say, if you set it up, you need to teach them how when they take money from it, when they take those loans, they got to pay their bank back. Because in life, they got to pay everybody else's bank, so why shouldn't they pay their bank back the same way? I think this is a perfect catalyst because it really teaches your kids some significant life lessons on how money really works and how to be in control of their money and how to take back the banking functions in their life so they never have to give that up. The next thing I want to talk about is versatility for life's expenses. You see, with the infinite banking concept, the policy can be used for a multitude of life expenses. Things come up in life all the time that are unexpected. And if they do, for your child, who you set up a policy for, that expense isn't unexpected because they've got the money there. And what are some other things that they can use this for? And the policy can be used for a multitude of life expenses. So what am I talking about? Well, your kids someday, like I mentioned, will need a house. They're going to need to finance a wedding. They're going to need to maybe finance a car, finance college tuition, or even plan for retirement. Why not finance all this with your own banking system where every payment you make on all these things goes back into your pocket, your banking system? You know, I like to think that's called financial security. So by doing this, what you're also doing is setting your kids up for perpetual financial security. They've got their own private banking system, and if you teach them how to use it, man, by the time they reach adulthood, they are going to be so much further ahead than we ever dreamed of because they will understand that they are in control of their money and that every dollar they spend comes back to them. I mean, come on, you hear me talk about it all the time. Get all the money back for every car you buy, drive, and own. So take that back to your kids. Your kids are 16, maybe they get their first car. How many more cars are they going to finance throughout their life? 5, 10, 15, 20, is it 50 cars? I don't know. It depends on how many cars they buy. And every car they buy, they get all the money back for? Yeah, using this system they do. I'm sorry, I get a bit excited, but this policy provides huge flexibility for your children, which is also what I like to call financial security. The policy serves as a financial safety net. You see, the growing cash value over time is powerful. It just keeps compounding over and over, and every time it compounds, it provides another layer of security. And I can tell you this, for most people entering their adult lives, financial security is a word that they don't know too well. Oh, and then there are tax advantages. Growth within the specially designed whole life policy is tax deferred. So if this is built right, this provides a tax-free environment for your child's wealth. Think about that. How many places do you know of right now that you can put money into for your kids that grows tax-free? I'm waiting. Oh, you thought of a Roth IRA. Yeah, but you can only put a little bit of money in them, and they need earned income to do that. You see, in this policy, because you are the owner and they are the insured, and eventually you'll pass this off to them, well, there's no limit. The limit is really on how much money you want to put away for your kids. But then we've got to talk about how do we hand this policy over to our children at the age of 18. The policy is structured so that it can be just handed over to your child anytime they reach 18 in most states. That gives them a huge head start on their financial planning and the ability for them to access a massive pile of cash value that they can use right at the cusp of their adulthood. But pass off the policy or to not pass off the policy, and when, is what you should probably be thinking about. See, some parents want to keep the policy until the day they die because, hey, they don't think their kids are responsible enough. And you know what? I hate to say it, but sometimes that falls back on the parents. Because with this, if we're going to set a policy up for our kids, we need to teach our kids how to use this. Should you pass it off to your kids or not pass it off to your kids? And if you're going to pass it off, when? You see, a lot of parents will decide to keep this until they die. And then when they die, the policy becomes the insured. That brings me to the question of, should I pass it off to my kids or not pass it off? And if I'm going to pass it off, when? You see, a lot of folks might want to keep their kids' policy until they die. Because when they die, then the child becomes the owner. But the problem with keeping the kid's policy until they die is the policy remains in their possession until the death. And that potentially limits your children's access to the policy's benefits. Sometimes some of the parents will spend the cash value or use the cash value, which diminishes the use that can be done by the kids. But there are problems with keeping your kid's policy in your name. You see, the policy, if it remains in your possession until your death, well, you're potentially limiting your kids' ability to access the policy's benefits, but more so, you're limiting your kids' ability to learn how to be their own bank. And that is exactly what you should not do. Because how much could you teach your kids about what you've learned and about being the bank? A lot. But not if you don't give them access to it and teach them how it works. So what are the benefits of keeping the kids' policy? But you know what? Some people would say there is a benefit to keeping their kids' policy in their name. Now, I know every family is going to be different and every family is going to look at this a little bit differently, but think about it this way. Lifetime coverage. So by retaining the policy until your death, what you're guaranteeing is that your children will receive the benefits. That's right. So whenever that is, they're going to get those benefits, no ifs, ands, or buts about it. So a lot of parents would look at it and say, well, should I pass it off to my kids when they're 18, or should I just maintain ownership of it until a day when I feel they're suited for it? Let's play this both different ways. If you pass it off to them when they're 18, I would highly suggest that you teach them how to use it. You teach them how to become the bank, and you teach them what the infinite banking concept is. Now here's an easy way to do that. Let me give you an example of how I would do it. So let's say I turned this over to Vivi when she was 18 years old. Now I haven't decided whether I'm going to or not. If she's mature enough and she applies what I taught her, then yes. But here's a good way to do it. Let's say your child turns 16 and they want a new car. Well, you could say, hey, listen, when mommy and daddy were younger, we set up your own private banking system. And that private banking system is especially designed whole life. But here's what we can do, Vivi. We can take a loan from your private banking and we can buy a car. And by the way, you've got $90,000 in cash value right now. So you could go out and buy a $90,000 car. But Vivi, if you buy a $90,000 car, you have to figure out what that payment would be to afford a $90,000 car. So the question really comes for you is, can you afford that monthly payment on a $90,000 loan? Because when you borrow money from your private banking system, you got to treat your money the same way you treat the other bank's money. Which means if you take 90 grand, you got to pay back 90 grand. And if the payment's too much and you can't afford it, well, guess what? Just because you can afford to buy it doesn't mean you should. So let's take out only what you can afford to repay on a monthly basis. So maybe Vivi can only afford a $40,000 car with her income at 16 years old. So she gets the car for $40,000. Every month, she makes a monthly payment, principal and interest, which we calculate, and I teach her how to do this. She makes that payment back to her policy as a loan repayment, because that's the infinite banking concept. You put the money in the policy, you take a loan from the policy, you buy the car, or whatever we're using it for, but in this case, Vivi's first car. Then Vivi makes monthly payments back to the policy. And then you teach Vivi that every payment she's making back to her policy is money that goes back in her pocket. interest and principal, and you show her the benefits of that. And then you say, sweetie, after 5 years, you will have gotten all the money back for this car that you just bought. So then, when you want the next car, we can sell this car and you'll have all the money back plus the money from the sale of the car. You can buy a better car. So if you start teaching them at a young age how this works, how to always make payments back to their policy and the benefits of doing so, that means they're going to be ready for you to hand over ownership by the time they're 18. But the other side of the coin is maybe they're not ready. So when they turn 18, you just maintain ownership. And you start teaching them throughout life how they have this money, but they don't get to use it until they fully understand the proper way to become their own bank. You see, there's so many different ways you can do this. You don't have to hand it over to them at 18. You can hand it over to them whenever they're ready to do that. Now let me give you a little bonus round here. Let's just say you've got a child and they're young adults. That young adult, your child, maybe what they do is instead of taking a policy out on their life, they take a policy out on you. That's right, you the parent. Why? Why would the child do that? Well, I hate to get morbid, but the chance of you dying is much higher than your child because you're older. And as we get older, we get frail and eventually we pass away. And when we pass away, if we have a policy funded by our child, the death benefit, pays back to our child, setting them up for life. Every family member has policies on them, and when one dies, it goes into the trust, funding the next generation. I wanted to just do that quick bonus round because it's so important for you to understand the proper use of this for legacy and for building your family's legacy so that it will never fail. So your next generation, your kids' kids will have a much better life, but they'll all understand how to use their own private banking system because you taught your kids the proper way to do it. But let's get to something more fun. That was kind of morbid, right? How about the potential cash value growth? So when you set up one of these policies, the way that we build them, because we build them for cash value growth, that cash value over time grows to be pretty impressive. Let me just put it that way. Like the policy I started on Vivi when she was 6 months old, that policy grows. If I gave you the returns, you wouldn't even believe them because that's just money growing over time. Compound effect, that's what it is. So the more policies you do for your children, the larger sum of money that will be there for your children to do the things they want without the struggles that you maybe had to go through in your life. But again, like I mentioned how I'm doing it for Vivi, until they know how to use the policy and how to use the infinite banking concept, they shouldn't be the owner of the policy. Because in ownership comes control, and in control comes the use of a lot of money. So here's some important things to do and to remember when you're going to pass on your policy. I already mentioned that when I was talking about Vivi's policy, but financial literacy. You see, inheriting a financial asset at 18 can be really overwhelming, not just for you, the parent, but also for the child. So you got to educate your children on the financial responsibilities that comes along with their own private banking system, their own specially designed whole life. And if they're not ready or not responsible enough, just wait. You don't have to hand it over to them at 18. And you don't want to overwhelm them with a policy that's got a whole bunch of cash value because then maybe they're going to go out and blow it. So be very careful when you're doing that transfer over to your children. And one of the things I always say is teach your kids while they're young. Teach them how to manage money responsibly. Heck, teach them how to be their own bank. And then there's always that maturity thing that comes into play, right? So at 18 years old, that they're legal, so they can own the policy because they're considered an adult, but that does not necessarily mean that they're at a financial maturity where they should have this policy and be able to use it. So having that financial maturity is a very important thing before handing the policy over. And then there's educational preparation. So you can educate your children on the complexities and how to manage a whole life insurance policy because they're really not that complicated. But you want to make sure that you do it the right way. So consider seeking advice from financial experts. I put out a lot of videos and you already know how to get them. You're already on this YouTube channel. So make sure that your kids are watching the same videos, understanding how they can use their policies and the infinite banking concept. And I know you hear me say this a lot. It's not the education that matters. It's the application of the education you give to your kids. Make sure they're applying what you teach them. because in the application becomes mastery. This is another thing I think about a lot, like a milestone-based transfer. So think about this, right? The one thing you might do is you might tie the full transfer of the policy over to different milestones that you set. So when you're thinking about transferring the ownership, set up milestones. Beyond reaching just the age of 18. A lot of people think, oh, they're 18, they're an adult, they can now own the policy, but set up milestones. And this could include things like graduating from college, reaching a certain age, maybe just them demonstrating that they're financially capable of managing this. So all of this plays into financial responsibility, and a lot of the financial responsibility for your children is going to come from you teaching them this. And then there's also the controls, right? You want to be able to control the mechanisms. So establish a power of attorney, okay? Maintain co-ownership for added oversight. Especially if you're concerned about your child's ability to manage the policy responsibly, co-own it. You could be the owner and make them a co-owner of the policy or a successor owner of the policy. I mean, there's so many ways you can do this, and you can even have it done within a trust. And then there's also the legal and financial safety nets you can put in place. So you can avoid a lot of legal complexities and potential misuse. Just lay out the terms and conditions for your policy's use inside of a trust or inside of a legal agreement you make your child sign. Think about that. A legal agreement your child has to sign in order to use the policy. It's not a bad idea. Think of a power of attorney like a co-pilot sitting next to you in the car, right? They got a steering wheel, a brake, and a gas pedal. So if you start to misuse the car or go a little too fast or not hit the brakes on time, they kick in. Well, that's kind of like what a power of attorney would be. And that's also what you can do with a trust. You can set the rules in a trust that allows them to use or not use the money that you leave for them. But starting a whole life policy for a kid offers them a big financial head start. So we've talked about a lot of stuff here, but the handoff, that's where it gets tricky. So to make it smooth, just ensure they're financially savvy, like I've talked about before, and consider linking the transfer to those milestones like we talked about. I love linking things to college graduation, to the other things that they do, like getting a really good job, just showing that they're responsible. But you know what? I think some of you might have some good ideas too. So if you've got a good idea of what you think a milestone would be and to how this could be transferred to your kids, drop that into the comments below. I'd love to read what your thoughts are. I think of some things, but I don't have all the answers, but you can certainly help there. And if you want more tips on the infinite banking concept, check out my playlist, because my playlists have all the other videos that are all related to the infinite banking concept. And if you enjoyed this video, I think you're gonna love this one right here, BYOB. Thanks for watching, and we'll see you on the next one.